Hello and welcome to the February 2026 edition of the Economic Update from Kingdom Focus Financial. We have today with us Michael Smith, Chuck Etzweiler, and myself, Derek Malden. Welcome, and let's take it away, boys. I think we're talking about our acronym WISER today, starting with W.
Indeed, we are. And Derek, I gotta say, your voice for radio, it kind of every month you kick us off, and it just like it mesmerizes me when you do that. And
Well, maybe I'm becoming wiser.
let's hope so. And certainly after this month, hopefully we all will be,
Yeah.
and this year. But hey, welcome everybody. Thanks for taking some time to join us here in February. The month of love, Valentine's Day, and hopefully you've planned something. This is your warning, guys, especially if you haven't thought about it. Get something planned before the 14th hits. But welcome. Last month, if you watched and followed us in our commentary, we kind of laid out our outlook for this year. And so this month, we want to start diving in a little deeper. And our theme for this year, as we mentioned in December, is the acronym of WISER. And so we're gonna break that down over the next several months and take each letter and kind of give you some specifics behind what it means and how that's driving our decisions in our portfolio. Chuck, thanks for being here. I know we've got W, the big W, right? The win on the calendar or the schedule for today. But in this situation, tell us what the big W refers to in our portfolios.
I'd be more than happy to, Michael, and great to be with both you and Derek as always. So here we have the acronym WISER in 2026. We did a podcast based on that, a kind of a summary format. So let's dig into the letter itself and what it actually means, as you just said. So you can see the slide. The W again stands for Washington, D.C. And I say again, we harken back to 2022, 4 years ago. It was the word wait. The W was Washington, D.C. Now, if you remember that period of time, we had President Joe Biden in office. We had a Democratic Congress, very similar to today, although blue is now red, right? President Donald Trump, obviously Republican. We have a Republican House and Senate. Thin, if you will, electoral advantages in both House and Senate, but it was the same in the calendar year 2022. We've historically spoken about midterm elections and what they mean to the investment cycle, but I wanted to add in a different perspective, and that's regarding healthcare. So let's just take a look at slide 2, and this kind of gives a summary about why maybe I'll use the word trepid this year. Caution would be another word that we used in our previous podcast, but went all the way back to 1962, so literally over 60 years ago. And you can see that what happens in a midterm election year historically is nearly a bear market. The average drawdown is 19.4% versus a non-midterm election year, which is much more benign at negative 12.7%. However, think about it like a rubber band, right? Physics would tell you the more you pull it backwards, the more it's going to move forward. And that's the good news behind all of this. You get a market drawdown of 19.4% historically, but what's on the other side is much better, at least based on history. Now, the bottom chart is very intriguing, gentlemen. The reason is you have to go all the way back to 1938 to find something that's occurred. So what is that something? Think about this. Let's go out to the election in November 26th. It occurs. You then forward 12 months into the future, November of 2027. You have to go back to 1938 when Franklin Delano Roosevelt was in office. The last time that period had a negative return, and if we know our history books, we know that that was the period when Germany annexed Austria, began the process of moving into Poland and basically starting World War II. You have to go back that far, nearly 90 years, to find that period of time. So the point, gentlemen, again, is maybe there's downward chop this year. But historically, once we get through the election and the great unknown becomes known, brighter days are ahead. Now, it doesn't mean we still won't be investing on behalf of our client base in the most prudent manner possible, because this chart would show, well, there is a silver lining, and historically, the silver linings come in the form of the healthcare sector, at least going back 50 years to 1973. So if you think about that time period, healthcare by both parties is deemed to be, we just call it a silver bullet. It could be a area of commerce that changes the outcome of the election depending on how the populace perceives it, good, bad, or indifferent. Healthcare is subsidized by the federal government in various forms, whether it's Medicare, Medicaid, certainly through the Affordable Health Care Act. But the key here is, and this has already started, guys, when you think about the administration has reached out to pharmaceutical companies, has cut deals on pricing. It's a political football, both blue and red want to appease the populace. They do it through their promises in healthcare. You can see the picture paints 1,000 words. Historically, year two's flat in a presidential year, bracketed by 1 and 4, which are close to average, as you can see in red. Year 3 is that follow through the slingshot. But look at year 2. Healthcare tends to be up on average 9% in a flat market. So what does that mean? It means in our clients' portfolios, we've done the process of making some changes to where we're adding to healthcare. Now, if I drill down into the healthcare sector, because there's many places that one could have their monies. There's the consumer, if you will, side of healthcare. You think of a company like Johnson and Johnson. There's certainly the insurers, if you think of a company like Anthem or Cigna. But really where this space is exemplified in its returns is in pharmaceutical and biotech. And again, going back to what's already occurred here in 2025/26 with the deals of pharmaceutical businesses and biotech. Those are the two sub areas which perform really well. You can see pharmaceuticals 9.7. This is going back to 1993. So we switched the date a little. Part of this, that's kind of the modern era, if you will, of government involvement in healthcare. You think about the Clinton administration when Bill Clinton was president, and actually he brought his wife Hillary on board to run at that time what was a healthcare initiative. Although it didn't pass in the Senate and the House, it did lead to what eventually became the Affordable Health Care Act under President Barack Obama. So here what you can see is biotech and pharma do fairly well in, again, year 2 of a president's term. So again, the law of averages, as you put it, Michael, would suggest that an overweight in this sector would be warranted, but even trying to find businesses that are specifically in pharma and biotech makes this area much more appealing. As I get to the final slide here, there's this old saying, gents, that you buy low and you sell high, right? I mean, you could probably find something that is not as trivial or trite as a saying as that, but it's true. It's amazing how the biotechnology sector really magnifies that saying. So we went back 25 years, and IBB is a low-cost index fund that represents the subsector biotechnology. And you can see from 2001 up until roughly 2014, IBB, as representative of that space, began to outperform the overall stock market. Significantly so. If you look on the y-axis, you see the ratio. However, guys, the last 10 years, it has been anything but that. It's been a significant long stretch of underperformance. So this is another thing that I think sets the table for this subsector to begin to perform. And many of these companies trade at very appealing price earnings ratios. They pay dividends. They actually grow their earnings. Yet, unlike some of the major tech companies, which have come under fire for being overvalued, here's a sector I think that's ripe for the picking from a fundamental standpoint. So you put on the fundamental cap as well as the political cap here, and it makes that healthcare sector, I think, very appealing for calendar year 2026, and thus the leading letter in our word wiser, the W, Washington, D.C. /healthcare as the leading sector for 2026.
Right. No, that makes a lot of sense. And certainly, put some data behind the strategies that we do. But as I'm listening to you talk, I want to try to put that into practical terms and what that may mean for this year. Certainly, last month we talked about our outlook and what this year could be in terms of having some pullback or flat or just a non-typical staircase look, right? And um, for you and your portfolios, here's some practical things of how that plays out. This would be the year where we maybe don't pull out large sums of money for projects or other things randomly. If you have needs that you know are coming, maybe you want to pay for a future vacation or a renovation or a new acquisition like car that's coming up, let us know those things early on, because we may want to set money aside when the market is up for something coming rather than having to pull it out at a timing because of the volatility that we may see as we go through the year. Another thing that happens, this is the kind of year where we invest in things that are going to pay dividends, and we want to reinvest those dividends to put it back in, buying while that market is low, or maybe increasing your contributions into your plan, either through your work plan or from your bank, your income into your non-qualified accounts. But those are just some practical things that our clients there could put into a market like this, and we'll be shifting sectors within the portfolio. But as they add money in, that often means more dollars buying in places where the market might be down.
Yep, absolutely. And don't forget, just in 2025, we had a major drawdown early in the year. And that's typical of this type of year, atypical of last year historically,
Yeah.
but typical of this year. And remember that the market still finished up. So even when we have a major drawdown during the year, don't think that the market still can't recover and have a positive year, because it can. Another thing with the biotech market in particular that I personally kind of look at is how it's driven by AI. There's so much new technology in that sector, and how AI is drastically pushing it forward, that I think that another reason why it's prime for the picking as well.
Great
Perfect.
point, Derek. You got it.
Yep. All right. Any other final thoughts, gentlemen? Otherwise, we'll wrap up this month. And I see you nodding there, Chuck. But hey, thank you. Can you believe we're already into month 2 of this year? It is going by quickly. So remember to take time to tell your significant other how much you appreciate them this year and caring for them. But pause and don't look at your portfolio every day as we move forward either, and trust the strategy that's behind it. Trust your long-term goals and objectives. We thank you for the trust you've put in us, and we'll continue to every month come and bring some of the strategies that we're implementing so you can understand and increase your knowledge of how that investment portfolio process works. If you haven't subscribed yet, hit that subscribe button. And how about this month, you take and you spread the love. Go spread our podcast to 4 or 5 people or friends you know that might benefit from hearing about this market this year. Thank you. We appreciate you, and we hope you have a great day.